Are you investing in Nvidia? Have you been riding the AI boom, or are you wondering if now's the time to buy the dip? If you've been watching the stock market, you know that AI stocks have been skyrocketing until recently. So what's going on? The artificial intelligence boom that has driven the stock market in recent years faced a significant test on Monday, January 27th. A major shakeup occurred when DeepSeek, a China-based open-source AI company, introduced its first model, DeepSeek R1. According to the company, R1 is capable of delivering performance comparable to leading AI models like OpenAI's GPT-4, Meta's Llama, and Google's Gemini, but at a fraction of the cost. This revelation sent shockwaves through Wall Street, triggering a sharp sell-off in the tech sector. The reaction from investors was immediate and severe. Fears that Chinese AI advancements could challenge US tech giants led to a brutal market decline. Leading AI chip stocks suffered massive losses. Within a single trading session, billions of dollars were wiped out. The anxiety stemmed from the possibility that DeepSeek's cost-efficient approach could disrupt the business models of American firms that have invested heavily in high-end AI infrastructure. Nvidia, widely regarded as the leader of the AI-driven stock market rally over the past 18 months, bore the brunt of the sell-off. Its stock plummeted 17%, erasing a staggering $593 billion in market capitalization, marking the largest single-day loss for any company in history. Broadcom saw a 17.4% drop, while Marvell suffered a 19.1% decline. The broader semiconductor sector was not spared, as the Philadelphia Semiconductor Index plunged 9.2%, its worst percentage drop since March 2020. However, not everyone saw this development as a crisis. OpenAI's CEO, Sam Altman, acknowledged the potential significance of DeepSeek R1, noting that competition in the AI space is a positive force. "We will obviously deliver much better models," Altman stated, "but it's invigorating to have a new competitor." Microsoft CEO Satya Nadella also weighed in with optimism, citing Jevons paradox, which suggests that as AI becomes more efficient and accessible, its use will only expand. This optimistic outlook helped stabilize the market by the end of the day. While the sell-off was dramatic, some investors viewed it as a short-term panic rather than a long-term threat. The tech sector managed to recover from its lowest points, signaling that while competition in AI is heating up, American companies are still positioned to innovate and lead. With the US government also prioritizing AI advancements, this development could mark the beginning of an even more dynamic tech race rather than the end of American dominance in the field. For investors, moments like these present a crucial question. Is this a buying opportunity? Historically, sharp pullbacks in high-growth sectors have often been followed by rebounds, and for long-term investors, the current dip might be an attractive entry point. Let's take a closer look at some of the key stocks affected by this AI-driven market turbulence and whether they still present solid investment potential. Number 1 on our list is Nvidia, ticker NVDA. Nvidia remains a dominant force in the AI and semiconductor space. The company's graphics processing units, GPUs, are integral to machine learning, data centers, and AI-driven applications worldwide. Despite the recent sell-off, Nvidia's expected earnings growth rate for the current year stands at an impressive 126.2%. The company boasts a return on equity, ROE, of 114.8%, demonstrating strong profitability. Additionally, the consensus estimate for its next year earnings has increased by 1.9% over the past 60 days. Nvidia currently holds a rank number 2, buy, suggesting that analysts still see strong potential in the stock. Nvidia's success has been largely driven by its leadership in AI chips, particularly its H100 GPUs, which have become essential for AI model training and deployment. With AI demand projected to grow exponentially in the coming years, Nvidia's market share in this space remains strong. However, investors should be aware of potential risks. The increasing competition from rivals like AMD and Intel, along with regulatory scrutiny on AI technology, could impact future growth. But before we proceed, here's a question. What's your strategy when a stock you own suddenly drops in value? Do you buy more, hold, or sell? Comment your thoughts below. Number 2. Broadcom, ticker AVGO. Broadcom is another tech powerhouse, specializing in semiconductors and software solutions critical to networking, broadband, and AI applications. While the company experienced a sharp decline alongside its industry peers, its long-term fundamentals remain strong. Broadcom's expected earnings growth rate for the current year is 29.6%, and its return on equity stands at 28%. The consensus estimate for its current year earnings has risen by 3.1% over the past 60 days, signaling continued confidence from analysts. Currently, Broadcom carries a rank number 2, buy, reinforcing its position as a strong long-term investment. One of Broadcom's major strengths is its diversified revenue stream. Unlike Nvidia, which relies heavily on AI chips, Broadcom has exposure to multiple markets, including wireless communications, networking, and cybersecurity. This diversification helps mitigate risks associated with a slowdown in any one sector. Investors should watch for Broadcom's ongoing expansion into AI-related applications, as well as its acquisition strategy, which has historically driven significant growth. Number 3. Marvell Technology, ticker MRVL. Marvell specializes in data infrastructure semiconductor solutions, making it a key player in the AI and cloud computing industries. While the company faced a substantial 19.1% drop during the sell-off, its earnings prospects remain stable. Marvell's expected earnings growth rate for the current year is 3.3%, and its return on equity stands at 4.6%. The consensus estimate for its current year earnings has increased by 6.9% over the past 60 days, reflecting a positive outlook from analysts. Currently, Marvell holds a rank number 1, strong buy, making it one of the more promising AI-related stocks. Marvell has been making strategic investments in AI-driven networking chips, which are expected to see increasing demand as AI applications continue to scale. While the company is smaller than Nvidia and Broadcom, its specialization in data infrastructure positions it well for future growth. However, given its relatively modest earnings growth, some investors may prefer larger, more established players in the space. Looking at the numbers side by side, it's clear that while all three companies face significant stock declines during the sell-off, their long-term fundamentals remain strong. Nvidia, despite suffering the largest single-day loss in market history, still boasts the highest expected earnings growth rate at a staggering 126.2%. That's a massive indicator of how dominant Nvidia remains in the AI space. Its return on equity is also sky-high at 114.8%, reflecting just how profitable the company is. Broadcom, on the other hand, offers a more balanced approach. It has a solid expected earnings growth rate of 29.6% and a return on equity of 28%, which, while lower than Nvidia, still demonstrates strong profitability. Its slightly higher Zacks consensus estimate increase over the past 60 days shows that analysts continue to have faith in its performance. Then we have Marvell, which, while experiencing the largest drop in share price at 19.1%, holds the most optimistic Zacks rank of number 1, strong buy. This suggests that analysts see significant upside potential. Its earnings growth rate is much lower at 3.3%. But its Zacks consensus estimate has risen the most, increasing by 6.9% in just 2 months. That's a promising sign for future gains. So what does all of this tell us? Well, even after a sharp correction, these companies remain giants in AI and semiconductor technology. Market dips like this can be nerve-wracking, but they also create opportunities. The AI sector isn't shrinking, it's evolving. Whether it's Nvidia's continued dominance, Broadcom's diversified approach, or Marvell's strong analyst support, each stock has a unique angle that could make it a great long-term investment. The big question now is, will investors see this as a chance to buy the dip, or will they wait to see how the AI race unfolds? Let us know what you think in the comments. The bigger picture: is this the end of AI's growth? Market downturns like this can be unsettling, but they often create opportunities for investors willing to take a long-term perspective. The rise of DeepSeek and similar AI firms underscores the rapid evolution of the industry, but it does not necessarily spell doom for US companies. Rather, it reinforces the idea that AI is becoming more accessible and competitive, which could ultimately drive even greater innovation and expansion. While Nvidia, Broadcom, and Marvell faced immediate losses, their core businesses remain strong, and the demand for AI-driven technology continues to grow. Additionally, American tech firms have deep resources and extensive R&D capabilities, allowing them to adapt and evolve in response to new challenges. The AI sector is still in its early stages, and as new players enter the market, the overall pie may continue to expand rather than shrink. For those looking to capitalize on AI's long-term potential, this dip could be an entry point into high-quality stocks at discounted prices. That's it for today's video. But before you go, here's something to think about. If you could invest in just one AI stock for the next decade, which one would it be? Comment below and let's discuss. If you found this analysis valuable, don't forget to like the video and subscribe to our channel, Simple Investing Secrets. And remember, this video is for informational purposes only and is not financial advice. Thanks for watching, and we'll see you in the next one.